What's up, guys? Welcome back to another episode of Sky's the Limit Podcast. I'm your host, Mike Doherty, and today we have an awesome guest. We have John Casmon of Casmon Capital Group. John is a real estate entrepreneur who has partnered with busy professionals, like a lot of you listening to this podcast today. He's invested over $145 million worth of capital into multifamily apartments. He also hosts a podcast, the Multifamily Insights podcast, and is the co-creator of the Midwest Real Estate Networking Summit. John's done a lot of different marketing campaigns within corporate America, working for companies like Nike, General Motor, Coors Light, and the list goes on. And he's got a very impressive resume. So with that, John, welcome.
Hey, Mike, thanks for having me here today. Really excited to chat with you and all your Sky's the Limit listeners.
That's it. That's why we're here. So I always like to ask all of our guests, why did you get started in real estate? You had a very impressive jobs working for all these, Fortune 500 companies. Where did real estate fit into all of this?
Yeah, it's right there, right? Had an impressive job, great career, working at General Motors, all the great things that one could dream of until it gets snatched away from you, right? So I was working in corporate America at GM. And I was there back in 2007 and 2008 when we went through bankruptcy. So I had a lot of time to see what happens when your dream job or your corporate career gets pulled from you. And a lot of my peers lost their jobs. Now, fortunately for me, I was young enough and early enough in my career where they still needed somebody to do the work. So I was okay. But I watched people who were lifers, guys who had been there 20, 25 years and didn't have a plan B. I watched those people get that phone call and they were let go. And in particular, there was one guy, he sat right in front of me and he got let go. He left us a voicemail. And I remember checking that voicemail and the pain in his voice. He was, I don't know if he was blindsided, but he clearly was really upset by it, didn't have a plan B. He had some health issues where he really needed the company to take care of that from a medical standpoint. And I just remember feeling a great deal of empathy for him, but also recognizing that I needed a plan B because at the end of the day, you can't control your career completely, right? You can do certain things, you can play the game, you can figure out the politics. But at the end of the day, this might be for political reasons, just somebody else gets the big chair and they don't like you, they want to put their guy in there. Or for different reasons, you just may get pushed out. So that kind of just taught me you better take control over it. And that's what I did. Real estate was kind of the vehicle that I looked at, and I went and did some research and tried to learn about stocks and other investing strategies. Real estate just kept popping up. And, there's that famous stat that 90% of the world's millionaires make their money or hold some of their money in real estate. And it just seemed simple enough, but also attainable enough where I could do it. And I had seen and read about it, other people doing it enough where I felt like I could actually do that, as opposed to like trying to invent the next great tech app or something like that. So real estate is kind of what I turned to. And I started to learn everything I could about real estate investing.
Nice. Very impressive. You have, hundreds of units now. So how does one go from, arguably not knowing too much about real estate to now owning hundreds of units? You're raising capital, you're syndicating, you have a whole coaching platform and education platform through Casmon Capital. It didn't start off. You don't go from corporate America to that. So can you walk me through a bit of a timeline as to, okay, you had this epiphany while working your W-2 job, to what was the first investment like? Was it a smaller duplex just to get your feet wet, or did you kind of you had those connections working, higher up in the corporate structure that you were able to raise a lot of capital right off the bat because people know, like, and trust you, and then you went and bought a 20 unit or a 50 unit? What was that transition like?
Yeah. So, my initial goal was just to get in the game, right? So my wife and I, we saved up money. We ended up moving to Chicago. And part of that process was we decided we wanted to invest. We did want to invest small like you started, right? So we bought a duplex, bought a 2-unit building. We house hacked it, which is a phenomenal strategy for anyone who's getting started, particularly if you're renting. If you're already renting and don't own a home, I love this strategy because you get to continue to live like a renter, but now you own the whole building, right? So for us, it was perfect to get started. We bought that property and it did so well for us that we were able to refinance out of that. We bought another property, a 3-unit building, and then we took the earnings with the line of credit from that first project and bought an 8 unit building. So we slowly started to scale our portfolio. But the challenge I started to run into there is now I'm accumulating these assets. We're growing a portfolio. I've got equity in these projects, but I don't really have the cash flow that I was anticipating. And you mentioned the connections and being able to raise money. I didn't think raising money was for me. First of all, while I knew people who had money, particularly from my corporate friends and corporate relationships, I didn't grow up around that. None of my friends from high school or college had a lot of money to invest. My parents didn't have money; they're friends, so I didn't see this pipeline where I could just reach out and call a few people and have them invest in a deal. Even the connections I had in corporate America, they knew me as a marketing guy, not as a real estate investor. So I thought it'd be a bit of a leap to get them to invest in our deals, particularly since I was still working in marketing. So that didn't really dawn on me until I was faced with a big decision. And what ended up happening is the agency I was working at, we had the same issue or similar issue that I had when I was a GM, where one day out of the blue, we ended up going bankrupt. And they come in, they be in the bank. They came in to our New York office and they started seizing assets. And as this is going on, I get a call, and I was in Chicago, so this is our New York office calling me, and they're asking what's going on. I'm like, I have no idea what you're talking about. I called the CEO, and the CEO doesn't know what's going on. And the short of this is, the company ends up having to close, files Chapter 11. The owners kind of spin off a new company and try to retain the clients they have. But at this point, my life stage has changed. I told you when I was a GM, I was young and junior, so it wasn't really that big of a deal. It sucked, but it was just me. Well, now I got a wife, I've got kids, I got a family to take care of, I've got these investment properties. So now I'm starting to freak out a little bit. And I realize the strategy that I was using to invest in real estate was a good strategy, but it wasn't the right strategy for my goals. You see, I was limited based on how much money I had. If I didn't have that money saved, I couldn't buy a property. So even though I could find these properties, I didn't have the money to invest in them, and that limited my growth. And once this second kind of bankruptcy happened with the company, I started to have more conversations with people and started to warm up to this idea of other people's money and trying to raise capital. But there was definitely some limiting beliefs and some fear that I had to overcome to make that transition.
Yeah, no, that's crazy. Good for you for making that transition, though. So, when you look at a deal now, how are you structuring it if you're
Yeah.
raising capital? Let's throw a $5 million deal out there. Maybe it's, I don't know the Cincinnati market that well, but maybe 5 million gets you a 20 unit apartment building, for example. So, arguably, you're going to need 25% down on that. Any lender is going to require, at least 25%. So I mean, it's quite a bit of money. So are you investing in that yourself, and then are you doing a joint venture on it, or are you syndicating that type of deal of that caliber? How are you structuring it?
Yeah, so there's really two ways you could structure a deal with another investor, right? You can do a JV partnership. So in a JV deal, you're going to have two parties come together. Maybe it's three or four, but you're going to have a small group of people come together. You're going to pool your resources together, and maybe everybody is doing the work. Maybe one person is taking the lead on the work, but you're going to go out there and buy that deal as a JV, right? But it's a small group of people, and everyone's going to be active, right? You're going to be able to weigh in and have access to the bank accounts and ask questions and all that stuff, right? So that's a JV. The second structure is what we call a syndication. And in a syndication, now you're going to have two groups of people. One group is going to be the active partners who are overseeing the deals. The other group is going to be passive, where they're simply just going to invest, but they're not involved in the day-to-day decision making. So on a deal like you just proposed, $5 million deal, if we've got to bring, let's call it $1.5 million to almost $2 million to the table, then that's large enough to go ahead and syndicate, right? Because you may not have someone who's got $1 million or $2 million just ready to invest in the deal. So you typically, if it were a smaller deal, let's say it was a 3 or 4 unit deal, you're buying it for $300,000 or $400,000. Yeah, you could find somebody who's going to invest maybe 100K or 200K and partner with you on that. But when you get into the millions of dollars of capital needed, typically that's going to be a syndication. So when we talk about deal structure, that can change. There's not a right or wrong way of doing it. What I will tell your listeners is this: there's two ways of looking at deal structures. One is for you as the operator. So in my case, I want to make sure that the deal structure is provides enough upside to warrant the effort that we're going to take. I think a mistake I see a lot of people make, especially young syndicators, is they give up so much of the deal because they just want to make the numbers work for their investors. The challenge is you're going to be in this deal typically about 4 or 5 years. And if there's not enough upside for you, then you can get burned out very quickly and also realize you just did a lot of work for very little in return. So you just want to make sure the deal structure is equitable. I will tell you, when you're starting out, you may feel like you need to give away more, but that could be a mistake, because if you give away too much, then you're going to feel like you actually cheated yourself and you weren't well compensated for the effort and the work you put in. And none of us like to work for free. Now, on the other side of that, as an investor, as an LP investor, I want to make sure that, again, the deal is structured appropriately, where that operator has the right incentives to perform, but also that I'm going to make a pretty good return on my money. And ideally, you want to see something that meets or exceeds what you can make in the stock market, which is typically going to be a 7 to 9% annualized return, or including the sell or the exit, that's probably going to be more of that 15 to 20% average annual return. But you really just want to get to know that person, right? It's really about people and relationships, understanding the business, understanding their structure. That's what's going to be really important when you're looking at kind of the details of how to structure that kind of deal.
Yeah, absolutely. And then as far as syndications go, I always get the numbers mixed up. It's either like a
Yep.
506B or C,
Mhm.
where you have to, is it a 506?
Yep, you got it right. 506B and 506C. Those are two
Yeah.
options.
Um, I think B is like people friends and
Yep.
family. I think you still have to be accredited, if I'm not mistaken,
Yep.
or maybe the C is where you have to be accredited and you have to be registered with the SEC,
Yeah, so
but
there's
you
two
can
ways.
freely
Yeah.
market.
Yeah, there's two ways, right? There's more than two, but there's two primary ways people use 506B and 506C. B as in boy is more of what they call the friends and family approach, where there has to be a pre-existing relationship. You can bring in sophisticated investors, meaning they do not have to be accredited. So the word sophisticated is somewhat loose in the way they define it, but in short, they have to understand the investment. What the SEC is trying to do is make sure that the people who are making these investment choices understand the level of risk. So they don't want you to, go get grandma who just got, some big life insurance payout and have her put all her money in this deal. She has no clue about real estate investing or anything, right? Like, that's what they're trying to avoid. So in that case, just because you know them, they want to make sure this person actually knows what they're doing. They understand the level of risk in the investment, and they're comfortable with making this kind of decision, right? So that's what a 506B offering is. And as you alluded to, because it is a private offering, you cannot go out there and solicit and market this. You can't post this on Facebook or put it out into the general public. Now, the other option is 506C, as in Charlie. And with 506C, every investor has to be accredited. And accredited is earning a $200,000 income, $300,000 if filing jointly, or having a net worth of $1 million. And the income requirement is for the last 2 years. So in this case, if everyone's accredited, then you can promote this more publicly, and you do not have to have all the pre-existing relationships. So in this case, the SEC basically says if you make that kind of money or you have that kind of money, you are savvy enough to make your own investment decisions. They're not trying to protect you as much. Now, obviously, they want to watch out for fraud and things like that, but they're less concerned with that person who's accredited, because it's not like the investor or the sponsor is preying on someone who may be a victim, if you will. So those are the two
Right.
ways you can do it: 506B or 506C. There are other ways, but again, those are the two primary ways
Right.
people look to put together these offerings.
In which one are you using?
We use a combination of both. It kind of depends on the deal. We try to figure
Okay.
out, based on the deal, what makes the most sense. We're starting to shift more to 506C, but starting out 506B is great. And, I have coaching clients that I work with, and this is a very common question that they ask. And the advice I give them is you likely want to start with 506B when you're newer, because the people who are more likely to invest with you are people who really know you and understand you, both your character, your work ethic, and some of those folks will likely not be accredited, right? So 506B gives you a broader network to start off with, but also you don't have the track record. So it's not like you're going to go out there and advertise this deal and someone that you don't know is going to see it and invest with you if you have no background, no experience, no track record. Like, that's not likely to happen. So your best bet is going to be to focus on the people that you know. As you scale, as you exit deals, as you build up your track record and you've got experience, now you can start to transition, do more 506C offerings, because you can share that with potential investors and show them, hey, here are the last 3 or 4 deals that we've done. Here are the returns that we have. We now are more of a proven operator, and that's going to make those investors more comfortable.
Right, right. No, it makes sense. So, one question I've been asking a lot of our guests is why real estate?
Yeah.
There's a lot of different, other than your active income, whether you're 1099 or W-2, there's a lot of other ways to invest your capital. Why real estate for you?
Well, it's a great question, right? First of all, real estate, there's so many strategies that you can utilize in real estate. I think it really is the perfect investment. If you don't want to be active, you can invest passively. We just talked about syndications, right? Investing in deals like ours. You could be a private lender, right? So there's ways you can invest in notes. There's strategies for someone who doesn't really want to be hands-on with the real estate. And then there's hands-on strategies, right? You can be a syndicator like I do. You can invest in rentals and be a landlord. You can do flips. You can do wholesale projects. So you can figure out your skill set, your abilities, and then apply them into the space. For me, the reason real estate is so appealing is, in a word, I would say leverage, right? So I get a chance to leverage not just my dollars, but my time and other people's resources. So I would compare it to maybe stocks. And I am not a stock guy. So if you are all into stocks, I don't even get I understand stocks, but I don't even get stocks to have a deep conversation with you. Like, I never got on the surface level. I've read books and I'm like, it just feels like a lot of risk to me. With the real estate, it's tangible. I can run the numbers. I have a lot of control over it. I can leverage other people. I can leverage banks. I can only put 20, 25, 30, 35% down. I can borrow money from other investors. I can get equity based on my sweat equity, my sweat capital. So to give you an example here, we did a deal in Louisville, Kentucky, right? So on this deal, it's a $12 million deal. We raised $4.5 million. I raised all this money from other investors and partners. Okay. Now I am part of the operating team, the general partnership team, but I actually did not invest money into this deal. Now, usually I do invest my own money in the deal, but just in the timing of this deal, we had just invested in another deal when this one came up. So I did not invest in this deal. Now, this is a $12.1 million deal that I was able to be a general partner in and not have to bring any capital. I don't know where else you can do something like that, right? Where I can go out there in a different industry and say, hey, based on my knowledge, based on my teams, based on my connections, we're going to do this. And then here's my cut, but it's not based off of my actual dollars. So I love that about real estate, and that takes time to grow and scale. On the flip side of that, I got a deal we're doing now where we're raising $6.5 million. Me and my partners are putting up, we have an investor who's doing a huge chunk of it, and then we're putting up the last 20%. And of that 20%, we're putting up a pretty healthy amount of it. So when you have that structure, we can invest heavily. We can invest a little bit, but you have so much flexibility in how you do the deals, right? Like, I can invest, I could do a 50-50 partnership. I could do a 80-20. I could do a 70-30. Like, there are a lot of options. And by the way, the bank is bringing the most of the capital, right? I'm buying this $12 million deal. Well, eight and a half of it, came from the lender, right? So now we're just bringing $4.5 million. So we have investors that bring the 4.5 million, and then are going to implement the business plan. We're going to grow it and ultimately sell it at some point and have a nice exit for everybody. So that, to me, when you talk about the leverage, the control, and when I say control, again, I can look at the market dynamics. I can look at market rents. I can look at the renovation plans. I can look at what my competitors are getting for their rents, what they're doing, other revenue resources. So charging for, let's call it for utilities. Like I can look at all these things and I can implement the business plan. Again, with stocks, you're kind of just, you're banking on those companies, and maybe you're looking at P ratios and stuff like that. But like it's really hard to understand the inner workings of those businesses and those executives and who's right and who's making the right decisions and all those kind of
100%.
things versus, in my properties, I know the market, I know the team, I know the building, and I can make pretty strong, not just guesses, but we've got a lot of data and a lot of practice and experience to help us maximize the value of these investments. So I just like the
Yeah, it's
control
control.
and the tangible nature of the business.
100%. You can physically go out and touch your asset. You can't touch a stock for all intents and purposes. There's a board of directors that the shareholders have to abide by or buy to. And there's so many macro and microeconomic factors that go into the market in general and what the price of oil is doing versus gold and this and that. And there's so many nuances to the stock market, and real estate is just, it's simple, it's easy, it's like it's you can physically go out and be there and control your own destiny. I've always wondered. I think I have a good idea, but I talk to a lot of investors such as yourself that are doing joint ventures, they're doing syndications, and the business model makes sense. But what are you actually taking as far as equity in those deals? Let's use that $12 million deal that you just took down. Congratulations, by the way.
Yeah.
Um, you're raising for the banks, leveraging eight. Let's say you put a couple bucks of your own money into it. Let's say you don't put any of your own money into it, like you did for the last deal. Are you getting anywhere from are you retaining anywhere from 10 to 20% equity for yourself?
So on a deal like that, and we bought it for like so that was the one we already own, right? So we bought that for 12.1. We raised 4.5 million. We had some fees and some other things like that to account for as well. The way we structure our deals with our investors, it's a 70-30 split. So it's not always 70-30, but that's kind of where we start. So in that case, 70% of the profits will go to investors. 30% comes to us as the investors ourselves or as the operators. So saying differently, just use an example. Let's say we make $100. Okay. Just $100. Well, based on a 70-30 split, $70 would then go to our investors. $30 comes to us as the operators. So when we think about that deal structure for that investor, it's got to make sense for them, right? There's got to be enough of a return for them for it to make sense. But for us, it's got to make sense as well, because this is where it goes back to how you structure a deal. Well, let's say it was 90-10, as you alluded to earlier, right? So in that same situation, well, $90 goes to the investors, $10 comes to us. Maybe that's great. Maybe it's a little thin and it's not enough money. You also have to think about the downside though. What if, in our case, what if you don't make as much money as you thought you were going to make? Well, now what? Because if you just break even, all of that goes to the investors, right? And you could be working for free. And I unfortunately have heard this where some folks have done deals where they're not going to make anything, but they still have to operate it because the way they structured the deal, they gave so much of the profits to the investors first that they actually won't make anything on these deals. So it's got to be something where it makes sense for everybody. But
Yeah, it's got to be
typically
fair.
speaking, we would start with like a 70-30 split and kind of adjust accordingly from there.
That makes sense. No, that totally makes sense. So, what's next for you? You're raising capital. You're doing joint ventures. You're doing syndications. You got the education component down. You host a podcast. Where do you see the growth of the company going? Are you just doing multifamily assets? Are you diving into or exploring self storage, industrial, land deals, development? Are you just focused on multifamily?
Nope, multifamily in the Midwest. That's our focus. So we're focused here. We like multifamily. We believe there's still a lot of upside and opportunity. So that's our focus. I will tell you, and what we do in our business is really about people, right? We really have two arms of our business: the education side and the investing side. And what we found is people really just need resources. They need help learning about the business, asking the right questions, figuring out how to navigate the landscape and determining, hey, is this a good deal? Should I be investing in this deal, or is this a deal I should be passing on? So to help people, we actually put together a free guide. It's called 7 Questions You Must Ask Before Investing in Apartments. And we have that available on our website, casmoncapital.com/7 questions. And what it gets into is really the framework of how to evaluate these opportunities, right? Understanding the market, understanding the team, even if you're the team, but it's like, who else did you surround yourself with, right? So the team, the deal, the opportunity itself, the business plan, it gives you a framework so you can really start to evaluate and poke holes. And it doesn't mean that, hey, if something comes up and there's not a good answer, that it's not a deal. It just means you may need to go back and find that answer, right? So whether you're looking for other people to invest with or you're looking for deals for yourself, it's a really good resource to help you ask the right questions so that you can get the right insights to help you make an informed decision.
Nice. That makes sense. Um, I'm a big mindset guy, and
Yeah.
you were successful in corporate America before you went in real estate. You're successful in real estate now. Any tips, tricks, suggestions about how to kind of get in the right mindset to become an entrepreneur, to kind of take that leap from what a lot of our listeners are probably in corporate America now, sitting in their cubicles, 9 to 5 type of thing. Any books you've read or any podcasts you've listened to that kind of, or any, do you journaling, meditation, maybe working out's your plug, but anything you do to kind of get your mindset right?
There's a lot, man. So much of this was like just BS to me, to be honest. Like, when I would hear people talk about mindset, it just sounded like straight crap. And and particularly if you're not in a good place mentally, if you're struggling, like when I was going through that second bankruptcy and I would seek out guidance, like it's all mindset. I'm like, man, no, I need an answer. How do I turn this flip project from a failure to a success? And I struggled with that, right? Because it just felt so glowy and soft, and I wanted something that was hard hitting and tactical and tangible. But I will tell you this, I learned it wasn't all BS, right? It really does come to your mindset, and you have to foster an environment daily. And it's about consistency, right? Because I could wake up energized and inspired all day, right? You can listen to me talk and put on a great YouTube video and be ready to rock the world. But, the moment life happens, you're right back into this space. And we all have self doubt. We all have this voice in the back of our head questioning everything we do and telling us you can't do it or you shouldn't do that or what makes you think you can do that. And you've got to find a way to quiet that voice and put the speaker to the voice that's giving you the reason that you can do it. So one of the things I like to do is daily habits. And one of the things I ask on my podcast is ask guests to tell me about a daily habit that helps them stay focused on their goals. And I have stolen from all of those guests, right? Like, because you hear the same things over and over and over. And I'm like, okay, there must be something to this, right? So one that I heard very often, probably the most popular one, is working out early. Well, now I work out 5 days a week, and I work out, pretty much wake up at 5 a.m., go get my workout in, get that first win of the day, blood's pumping. The body is the one thing you can't outsource, right? I can't let somebody else work out for me. I could pretty much have someone do almost everything else for me. I can't do that, right? So that I've got to take care of first thing in the morning. And then I would say getting clarity on your goals and your why, and journaling. If you like journaling, what I use is I want to call it manifestations. I would do affirmations, but the challenge I had with affirmations, I would like when I learned about affirmations, it just sounded like lying to yourself. Like, oh, I am rich and I live in Hawaii, and I'm like, no, you don't. So I struggle with that. And what I have shifted in the way I do my affirmations is I actually write down the qualities and traits about myself to remind me of how I need to show up. So I talk about my energy, I talk about discipline, I talk about focus, I talk about, the kind of person I am and want to be. And that kind of allows me to flow. So it's not about I have X amount of dollars while I live here. It's really about this is the energy that you want. I have high energy, I'm focused, I'm this, I'm that, right? So it's these reminders so that I can kind of lock in and attack the day with the right framework. That has helped me a lot. And I write that down. I got it on the board over here. I've got it on my whiteboard over here. So it's in my office. It's visible. you got to just stack these things, right? So it's a lot of little things, but if you can stack them up, then I think it helps you to shift your mind.
Yeah, no, it's really good. I also am not a morning person, but I do try to work out in the morning. But the first thing I do when I wake up is I make the bed. It's the easiest win you can have of the day.
Yeah,
Get out of bed, make the bed, chug a glass of water, hit the gym, try to get back at a reasonable hour, and then your day's set. I've always my entire life worked out after, whether you're working a W-2 job or 1099, whatever, working out at the end of the day. But there's always so much that comes up that's so easy to take you away from that workout. So
absolutely.
also a really big proponent of that. As much as I hate waking up early. I'm still got to drink coffee at 2 o'clock in the afternoon here, but um, it's really important. It just sets the tone of your day. So no, I really appreciate those tips and tricks. Well, thank you so much for your time. We try to keep the podcast to 30 minutes, so we're right there. I know you're a busy guy, busy entrepreneur. Thank you. And we'll link all the show notes at the bottom, so all our listeners can learn more about Casmon Capital, about your education, about your podcast. And John, thank you so much for coming on the show today.
Absolutely. Thank you for having me today. Great talking to you and all your Sky's the Limit listeners.
Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.